Companies often incur expenses without immediately paying cash. For example, when you book a flight for a business trip, the company's travel agent may issue flight ticket, and may only collect the payment at the end of the month, or even at the end of each quarter for simpler operation. This video illustrates what happens to the financial statements in such scenarios. First, expense incurs, pushing down net income by the same amount. Instead of reducing the cash as we saw in the last video, accounts payable is booked in the balance sheet. Accounts payable is a liability of a company. It represents a promise to pay, showing in the balance sheet how much the company owes money to the third party. In other words, it shows that the company has an obligation to deliver cash as it promised. Debit expense $5,000, credit accounts payable $5,000. As we can see, both the debit side and the credit side increased by $5,000. Retained earnings reduces by $5,000 as net income decreased, and this is how the BS looks like after the transaction. Later, on the date agreed with the travel agent, the company makes payment by cash. This reduces both cash and accounts payable by $5,000. Debit accounts payables $5,000, credit cash $5,000. Because both sides decreased by $5,000, the debit side and the credit side remain equal. Note that after paying accounts payables, both BS and income statements look identical to the previous video where the company paid expenses by cash.